Welcome, everyone, to another episode of Money Moves with John Russell. Thank you for joining us today. I'm here today with Cody Richer. She's a mortgage broker at Loan Market. Okay.
Hi, John. How are you going today?
Fantastic. Thank you. Cody, do you want to tell us a little bit about yourself and where you've been?
Yeah,
Where you come
definitely.
from?
So I have a banking background. I was with ANZ for about 10 years before transitioning to Westpac as a home finance manager, where I was there for 3 years. And then I've been broking for the past 2 years in my own business. And yeah, it's going really well so far. I'm with Loan Market, and I just wanted that big brand backing. So that's why I chose to go with them.
Fantastic. Well done. Excellent. It's always interesting starting out in business, isn't it? Like,
Yeah, you're learning not only, how to be a broker essentially, but how to run your own business at the same time. So it's a big learning curve at the start.
what not to do.
Exactly.
Fantastic. What made you get into broking and finance, I guess?
That's just I guess it's been my passion for the last probably 8 years, I would say, is helping customers find their dream home and helping them build their property portfolios. So yeah, I've been interested in property for a long time, and I love helping clients along the way as well.
Fantastic. What's your biggest client's property portfolio? How many properties should that?
I've helped one client this year with 6 loans. So that's in 1 year so far. And I've got another client that's probably up to about 7, but he's bought and sold along the way as well.
Okay. Fantastic. Excellent. Oh, it shows you that money keeps moving.
Yeah,
That's good.
definitely.
And in terms of starting out in broking and the business, what did you find was the biggest learning curve?
I had in my head a lot of things that I thought would be challenging, which was having less control. Being at a lender directly, I could approve deals myself, and I thought that would be a big challenge, but it actually hasn't been at all, because you can choose a lender that's going to get something done in the time frame that you need. So the biggest challenge, I would say, would just be having so many options of different lenders. You don't have to research every single one. You just need to research a few that you know are going to be the right option for the customer, and then find the best one out of those.
Sure.
So not overcomplicating the process by researching every single lender.
Sure. Who's your favorite go-to at the moment? Go-to bank.
I do a lot of lending back to ANZ and Westpac,
Yep.
just because I know their policy inside and out. I know it's going to get approved. And then I use a lot of Burstmac as well.
Yep.
They've got a really good servicing policy, so they can lend a lot more than the mainstream lenders can.
Sure. Excellent. Done. And what's been a good win, I guess, in that first 2 years of running your own business? Like big win for a client, like being able to push different, bank BDNs to get good outcomes. Like what's been the most memorable one that you can piece together?
I think that the best thing is that I haven't actually had to turn anyone down or say that I couldn't help them. So I've been able to essentially help everybody that's come to me so far, whether that be right there and then or in a few months later. One client came to me with less than 12 months in their new business, so they were self-employed, and they were told by a few people that they didn't have enough deposit and they hadn't been in their new company long enough. But we were able to get it through with 10% deposit, 6 months BAS, and they were ecstatic.
Excellent.
Yeah.
Doesn't sound like an easy.
No, it's not an easy one. You need to give a good story as to why this client is essentially a good client.
Sure.
So a bit of a backstory as to what risks there are and how you can mitigate those risks.
Sure. What about first time buyers? What are you seeing in that market at the moment?
They're a bit scared.
Yep.
Because I guess the media is saying that, it's really hard to get into the property market. They think that they're never going to be able to get there, and they're putting off coming and seeing a broker for a bit too long. They think that they need to have 20% deposit. They need to have clear conduct for 6 months. They need to have all these boxes ticked before they even approach a broker. And it's a little bit too late then, because we can, from the start, put them on track to be able to purchase in their ideal time frame.
Yep.
And they may be ready now rather than having to wait another 6 months or 12 months when property prices have gone up even further.
Sure. Yeah, that's really important to remember, because I always say to clients here, can't outsave the pace of growth in the market.
Definitely not.
So what does that 12 months cost you in reality? And sometimes it's literally the price of getting into the market. Make sure we just can't get in because you've waited too long, and you've scenarios are just in that sense, you just can't get back in. Like you need a second line, or
Yeah.
baby mum and
Or you're going to have to
stuff.
significantly reduce the purchase price that you could have afforded 12 months ago.
Yeah, exactly. One thing I mentioned to clients, particularly when it comes to investments, is buy what you can when you can, because you sort of just don't know when markets are going to move. And that it runs through what you're talking about now, because even not just with not just with first home buyers, but with investing as well. A lot of people have a certain idea of what they want, and it might be a house with white picket fences.
Or they need to wait until the rates come down a bit more, or until they do hit that 20% deposit, because that's going to be the right time. But when I think the right time is when they find that perfect property and when it suits them. There's not going to be a right time for the market to purchase, because you don't know what's going to happen.
Sure. And on that, what do people really, I guess, need to know before, getting in contact with you or applying for a loan? Like, is there anything that you sort of pick up the phone and go, you do need to sort this out first, or do you just sort of help them the whole way along?
I think they need to talk to somebody early and just get advice as to, exactly what they should and shouldn't do. One thing I tell a lot of my clients is that they need to do their borrowing capacity before starting to look on realestate.com and just confirm what they can afford based on their current situation. And then start looking at realestate.com, because you don't want to fall in love with the property and be disappointed when you go and speak to a broker about your borrowing capacity. And also, you don't have to choose the first broker or finance person that you speak to. It's a personal journey, and the broker that you choose or the finance person that you choose to help you should feel right for you, and you don't have to just stick to the first person that you talk to. You need to trust them, and you need to feel confident with the advice that they're giving you.
Sure, absolutely.
So keep shopping around if you don't get the feeling on the first meeting.
I'm sure you don't turn away too much. I'm sure people are comfortable with you, which is good.
Yeah, most of the time.
And in terms of mistakes that clients make, that you see clients making, particularly not so much in the lead up, but more so in general, like through the course of a loan, they say 30-year loan terms. What are some like really common mistakes that you see for owner-occupiers and investors that make mistakes?
I guess before settlement and before getting the loan is just not having enough savings or buffering in enough savings to cover everything like purchase costs, conveyancing, moving costs even. You don't want to be left short and have to scramble at the end. And then once you've got the property, once you're purchasing multiple properties, is just structuring the debt and the lending correctly. So if you're thinking about selling one, you don't want to cross-secure. If you have a lot of savings that's in your offset for your primary residence, you don't want to use that savings to go and purchase an investment property. You want to pay down the owner-occupied debt and then maximize your investment debt. So it's tax effective. And you need to get the right professionals in to give you this advice at the start. So an accountant, a property investment advisor, a broker. So just getting the right professionals in your corner is really going to help.
Sure. Yeah. Do you see that regularly? Like I certainly do. A lot of clients sort of go in their first home and go, this is a great investment. I'm going to move from here to a new home. And they load up on debt with that new home. Do you actually see that happen, and obviously prevent it?
Yeah, sometimes it's too late. They've already paid down their the one that they're going to convert into an investment so much, they can't redraw that money back because it's actually paid off the loan. So if you can utilize an offset account and build up the funds in there, that's going to be the safest way because you can move that money around how you want to.
Yeah, absolutely. And I speak a lot about debt recycling to my clients, and obviously the every adult sits in your offset account is saving over a rate of X, whatever your home loan is. Tell me out there realistically, like what level of client, like what percentage of clients actually understand using offset accounts properly?
I think most people understand the basics of using an offset account. They know that it reduces the interest, but they wouldn't know what debt recycling, and majority of clients wouldn't know what debt recycling is, and that they can pay down debt unoccupied, split that off, and then use that funds for another purpose. So it's just educating them as to the easiest way and the most, I guess, efficient way to structure their personal scenario.
Sure.
And trying to just educate clients from the very start. It's not just a tick and flick where you do pre-approval, you do the application and put them on their way. Educate them. This is what you want to do now. This is what you want to do next. And therefore we should take these steps so that you're in the best position to be able to achieve those goals.
Sure. And what about understanding of equity and how equity works? Obviously, a lot of people do understand how it works, but I've, in my experience, again, a lot of people sort of don't.
Yeah, I think a lot of people think they understand it, but they do the calculations totally wrong. They don't understand the actual reason why they can borrow 80%.
Sure.
And why that calculation's put there. They just feel, I've got 80%. I've got 80% equity available, so therefore I can use that to purchase another property, but they don't actually realize they still need to be able to borrow the funds.
Sure.
They think having the equity there means they can use it all. But you still need to have the servicing position to be able to borrow that full amount.
So that, and particularly with high interest rates, right? That's where confusion will totally be over.
And there's a lot of talk about utilizing the equity you have in your property. People are like, I need to use my equity. I need to use my equity for something. But they don't understand that they need to be able to borrow that for whatever purpose it's going to be for.
You have to maximize your cash flow at the same time, which is good. All right. Well, so that's a little bit about, I guess, clients and situations and whatnot. I'd like to talk about the market generally, right? What's changed in the market? Obviously, we're seeing interest rates start to drop now. I feel at a pretty comfortable level. Obviously, the RBA is not, completely lowering them. So, which is a good thing, I think, in terms of stability. What are you seeing in the banks and all that sort of stuff?
There's a lot more. There's a lot more schemes and benefits that are now available for first home buyers. So, if you are a first home buyer, you probably don't know everything that's available. So I would recommend getting in touch with a broker to chat about that. Other changes, I would say that, the property prices and the market, it just keeps increasing, whether it's not probably as fast as it was post-COVID, but the market is still steadily increasing, and people think that if they keep waiting, it might slow down or it might go backwards. That's highly unlikely going to happen. We're in a steady increasing market, I would say. What else?
And interest rates, what's your prediction for end of the year?
I think we'll see another interest rate decrease at least this year. And we'll just have to see what happens for the rest of the year with inflation, if it keeps stays in the target level or if it goes back up again.
Absolutely. And in terms of banks, how they're assessing borrowing capacity at the moment, have you seen any lenience towards like assessment rates and all that sort of stuff as rates have obviously come down, or are they still pretty strict around all this sort of stuff?
There has been talk about reducing the serviceability buffer from 3% back down to 2.5%, which will help people borrow probably $50,000 to $100,000 extra. but it hasn't been put in place yet. The major banks are still doing new property purchase servicing on a 3% buffer on what the actual rate is that they're getting. But you've got smaller second and third tier lenders that are doing it on a 2% or a 1% buffer. So with those banks, you can borrow a lot more because it's across your entire portfolio, not just the new loan that you're applying for.
Sure.
And if you want to refinance, but you got your home loan at a low interest rate and now you can't afford it on a normal servicing buffer, which is 3%, a lot of lenders are doing refinances just on a 1% buffer.
Sure.
And if you can afford that, they'll let you refinance even if you can't service normally, so long as the new repayment is lower than what your current repayment is.
Sure. Okay. And in terms of, let's say, utilizing equity to an investment property, for instance, what is the difference? But just for listeners, what's the difference really between those assessment rates? Say if I wanted to go out and buy a $600,000 investment property, what do those assessment rates do to my borrowing power? Like, obviously increases the lower they get, but in terms of real like rubber hitting the road, am I looking at the ability to borrow more? Am I looking at increase rates? Like what does that sort of look like?
So across the lenders that will do a decreased servicing buffer, they do generally offer a higher interest rate because they're taking on a little bit more risk by lending you more. But the difference between the second tier lenders and the major lenders can be $500,000, can be $1 million if you've got multiple investment properties and they're all calculating that buffer on 3% versus a 2% or a 1% buffer. It could be another 2 properties or 3 properties that you could purchase with the likes of Liberty or Pepper or First Nat compared to Commonwealth.
Interesting. Okay, that's very interesting. And so with that in mind, do you have any tips for investors and first home buyers alike in terms of, loan structuring or, where to look?
Yeah. I would suggest to not believe what your current bank is saying is the best, because there's so many lender options and your bank can only give you essentially one option.
Sure.
And that's why it's important to speak to a broker because they can compare every single lender on the market and find the one that's most suitable to your situation.
What about like money smart calculators and stuff like that? I know a lot of people jump online that typically they'll use the CBA borrowing capacity app, which is very misleading, obviously, because it gives you your borrowing capacity, but it doesn't factor in savings and whatnot. What do you say to those sort of people? Do you have to rein them in a little bit?
Yeah, definitely. I would say those calculators aren't very accurate because they just are based on the numbers that you type in. Yeah. You might type in your income, but that might not be essentially all the income that the bank can use. And your expenses as well, different categories will equate to different, pretty much different expenses that the bank will put into your minimum household expenses.
Sure.
So each bank has a different measure that they use for your household living expenses, and different categories go inside or outside that. So that could also be a big contribution to your borrowing capacity. Private school fees is obviously a big expense. And some banks will consider that inside HEM, which is household expense measure. Some banks do that outside HEM. So that could be the cost of $400,000 in borrowing capacity if you've got a $20,000 private school expense.
Yeah, wow. Okay, interesting. Really interesting. So that's the investors side. What about first home buyers? Obviously, there's a myriad of different ways that people can do research and whatnot. Obviously, like we do house and land stuff, we do apartments, townhouses, existing dwellings. So we do everything. But when it comes to first home buyers looking at opportunities, is there like a easy way to do things or a hard way to do things? What's your commentary there?
I think for first home buyers, it's a totally new process to them. They don't know how to make an offer on a property.
Yep.
So that's an education piece. They don't even know that they need a conveyancer.
Yeah.
They don't know that they can purchase with as little as 5% or even no deposit if they have a family member that can help with a family guarantee.
Yep.
So it's just getting the right advice early.
Sure.
Don't listen to your friend Bob at the barbecue, because his advice may not be right for you, and it may be 20 years old.
Sure.
Things have changed, especially since the Royal Commission and COVID. So it's important to get the right advice from professionals early.
Sure. So I'm hearing call Cody early.
Yes.
Excellent. All right. So a few little hot tips that I thought you could run us through. So any tips to increase your borrowing capacity?
Reducing your credit card limits.
Yep.
Putting forward all the income that you have. So you might have, dividends from shares or a pension or something like that. Letting the banker about all the income that you have, and finding the right lender. So some banks will have a cap on rental yield, whereas some don't have any cap. So if you've got really high yield rental properties, you might be more favorable going with a particular lender over the lender you're with that only does 7% maximum.
Sure.
Rental expenses as well. So if you've got a short-term lease or short-term rental property on Airbnb or something like that, you're going to have high expenses, but you're also going to have a high yield. So finding the most suitable lender that will take all of that income. What else?
What about for small business owners? Obviously, it's a different. Okay, a lot of small business owners think it's too hard. Like I'm not doing it, right? But something that I see quite often is small business owners trying to reduce the tax they have to pay, right? Which is reducing your income. And then they complain when they can't get a loan, which is a common thing I'm sure you see as well. Is there any commentary around that?
Well, what a lot of people don't know is that we can use some of the expenses in the business and we can add that back as income. So depreciation or interest and your net profit, that can all be added to your personal income to increase your borrowing capacity. But business liabilities also come into play. Some lenders will expense those business liabilities and take them off the total income, whereas some don't. And you can do it. You can borrow being a new business owner. So some lenders will let you do as soon as 6 months in a new business. It's just about finding the right lender for your situation. But yeah, it's definitely not as scary as a lot of people think. Being self-employed, it can be actually more beneficial. I had a client that had been offered a contract to go PAYG instead of self-employed, and his borrowing capacity was going to be lower under self-employed than it was under lower under PAYG than self-employed, but same income.
Sure.
Because he could say where his super was going if he wanted to, could put that into super.
Sure.
He could deduct things that were then treated as non-taxable.
Yep.
So it can be more beneficial being self-employed than
sure.
employed.
Good to know.
Yeah.
And sort of on that, obviously, I spoke about borrowing power, increasing borrowing power. What about first home buyers? If you were a first home buyer now, and let's say you had, I don't know, 20K in the bank, what would you do to get your foot in the market?
Sorry. I would look at, all your options. Essentially, if you're renting, your rental ledger can be your genuine savings. You don't need to have 5% there and then. Then you've got the Queensland First Homeowners Grant. It's doubled. That's $30,000. So now you've got $50,000 to use as your deposit. You also don't have to pay stamp duty if you're purchasing for under $700,000. So you could essentially go and buy a house and land package for $700,000. There's no stamp duty. You've got a $50,000 deposit. You don't have to pay LMI if you go for the scheme, and your loan's only $650,000, which is affordable.
Yep. If you're paying $800 a week in rent,
Exactly.
That's probably it. Yeah, pretty much the same run.
Yeah. And when you go for the scheme, the government guarantee scheme, you're achieving much more competitive interest rates.
Sure.
The same as somebody with a 20% deposit.
Sure. Amazing. Excellent. And with that, I know these days a lot of first home buyers and investors, they have, your not payday loans, but your afterpay sort of stuff. So they have bad credit, well, in their opinion, they have bad credit history. What do you say to that?
As long as you can afford what you're spending,
Yep.
it doesn't really matter. Also, people think that you need to supply 3 months bank statements and it's going to get scrutinized by the lender. A lot of lenders don't want to see your bank statements. They just want to see your pay slips.
Yep.
The broker's job is to look at your bank statement and discuss your living expenses with you and make sure that the loan is going to be affordable. If you want to reduce your spending post-settlement, that's also something that we can put forward. Credit cards are a lot different than things like Afterpay. A credit card limit of $15,000 can reduce your borrowing capacity by about $80,000.
Sure.
Compared to Afterpay, which might be $40 per month. That doesn't really affect you in terms of borrowing capacity.
Yeah, okay, right. Interesting. So lower your credit card limit if you're not using them.
Yeah, but don't lie about the facilities that you have. If you have Afterpay, just disclose it. Say you've got Afterpay. It's totally fine.
Sure. Okay, cool. That's one thing. One thing people obviously need to be is transparent. Yeah. As the bank will find out, as we know. So look, there's a quick little quick fire round, and I'll just ask a few questions, and you just tell me your immediate response. Okay. So offset or redraw?
Offset account.
Okay. Fixed or variable?
Variable.
Yep. I'm variable, which is good. Low doc loans, or are they legit or loopholes?
I think they are legit, so long as your accountant is transparent and not just signing off what you're asking them to sign off.
Doing their job right.
Yeah, I think they're great for people that haven't. They might be behind on the tax, or it might be changing the following year or this year.
Cool. Excellent. And what market do you see moving in terms of property markets? Obviously we're in Brisbane.
Mm-hmm.
It is crazy right now in Brisbane. What do you see? Like where do you see value in markets across Australia?
I think looking in other states, not just where you live, diversifying your portfolio. If you've already got 2 properties in Brisbane, why not look in Melbourne? Diversifying your portfolio. I think everywhere property prices is going to keep creeping up. Just doing your due diligence, doing your research, and making sure the property that you're looking at is got no hidden threats or anything. And I think, we're going to see more growth, especially coming up to the Olympics.
Absolutely. Couldn't agree more. And so I've got two little questions I tend to ask to everyone, particularly working professionals. If you were to give anyone advice about setting someone up financially from where they are now, let's say they have a mortgage and they're paying it off, they're making minimum repayments, regular sort of lifestyle, kids and all that sort of stuff. What is one thing that you'd tell them to do, just like absolutely focus on, like that's easily and readily available, that to pretty much everyone, that they should be doing if they're not?
I think mainly being aware of what you're spending. So actually keeping track of what you're spending each month. Have a budget. Don't just spend and think that it'll all be fine. Keep track of where you are spending your money, and then have a look at where you could be cutting costs, and try and pay that little bit extra off your mortgage, because that's going to save you years and years and lots of dollars worth of interest. Have an offset account. If you've got multiple accounts, a lot of banks these days can let you have up to 99 offset accounts. So you can still have sub accounts for different purposes, and they can all be offsetting your mortgage. And that's going to be a lot more beneficial than having a savings account that earns interest that you then have to pay tax on.
Sure.
So I think being aware of where and what you're spending, and where you can, offsetting all your cash against your mortgage, against your primary residence mortgage.
That's a good start. And last one, this is what I sort of like to ask everyone that sits in the seat, is what's the biggest fail you've seen in like your career in terms of either mortgages or property? What's the biggest thing that makes you still laugh to this day, and were you able to fix it or solve it?
I think challenging sometimes assessors.
Yep.
I've seen things get declined that are 100% a done deal, but the assessor might have interpreted credit policy a little bit wrong. And if you have a gut feeling that it should be a deal or you can get it done, to push for it and don't just take no for an answer. Speak to the BDM, speak to another credit assessor and push for what's right for the customer.
Sure.
I had a client that was he was building an extension on his existing house, and the bank only wanted to lend him 70% of what the construction amount was for an extension. It wasn't a new build, it was just an extension to his existing house. So they were totally discounting the dwelling that was already there, and only letting him have a further lending of 70% of what his new construction was worth, which is just for an extension.
Sure. Yeah.
And that was totally wrong. It took a little while to get across the line, but we got there in the end.
Fantastic. It's always good to hear about solutions in those scenarios. I never ask people that question without wanting to hear the solution, because often a lot of people hear about the problem and don't hear about the fix.
Yeah. And I feel like if you go straight to your bank, they if they don't have the solution for you there, then they'll just say, no, sorry, I can't help. They don't always offer another solution or another option.
Sure.
So don't just, if you've gotten a no from your bank, don't think that that's the end. Go and speak to a broker and see if there's another avenue that you could go down.
Excellent. Well, thanks, Katie. Where can people find it?
You can find me at 89 Latrobe Terrace in Paddington, or just Google Cody Richter Loan Market.
Excellent. Fantastic. Well, thanks for your time. It's been a pleasure. Hopefully you guys have taken a lot from Cody's time with us today. I will do a follow-up 5 minute sort of recap of this episode later on. But thanks for listening. Awesome.
Thanks, guys.